You were never meant to learn about this in the way you're learning about it right now. Not through an official letter in your mailbox, not from a conversation at your local Social Security office, and certainly not from the evening news. Because the people responsible for managing your retirement income quietly made changes and tucked them inside pages of federal policy language most Americans will never read. But that's not good enough. Not when it involves money you paid into for decades. Not when it affects the income you depend on every single month. Starting May 1st, changes inside the Social Security system began taking effect, and every retiree in America needs to understand what they mean before the next deposit hits their bank account. This isn't about panic, it's about clarity. I'm not here to exaggerate. I'm not here to twist facts. I'm here to lay out what changed, why it matters to your income, and what you need to do right now to protect yourself. Because the difference between people who protect their retirement and those who slowly lose ground often comes down to one thing: information. Not luck, not special access, not insider connections, just knowing what's happening and acting before it's too late. So here's what we're going to cover. First, the cost of living adjustment that officially showed up in your May payment and why that raise may not stretch as far as you think. Second, a historic reversal of two long-standing provisions that reduced benefits for millions of public sector retirees, and why May is when those changes finally start to show up. Third, Medicare Part B premiums that are quietly reducing your Social Security check, and a little-known appeal process that could save some retirees hundreds of dollars a month. And finally, the earnings limit and taxation rules that can quietly chip away at your retirement income if you're still working. Let's begin with the cost of living adjustment, the COLA. For 2025, the Social Security Administration announced a 2.5% COLA increase. On paper, that sounds positive. It means benefits were raised to reflect inflation. For the average retiree, that amounts to roughly $50 more per month, about $600 per year. For couples, it could be closer to $1,200 annually combined. That adjustment is now reflected in your May deposit. But here's the problem. The COLA is calculated using the Consumer Price Index, a broad measurement of inflation across the economy. The CPI tracks a general basket of goods and services, but retirees don't spend money like the average working-age household. Retirees spend disproportionately on healthcare, housing, insurance, and prescription drugs, categories that have risen faster than the overall CPI. So while the government says inflation was 2.5%, many retirees feel like their real expenses rose far more. Does your grocery bill feel like it only rose 2.5%? Did your insurance premium increase only 2.5%? Did your prescription costs stay close to that number? For many people, the answer is no. And here's where it matters most. That $50 monthly increase can quickly shrink once other deductions are applied, which brings us to Medicare Part B. For 2025, the standard Medicare Part B premium increased to $185 per month, up from $174.70 the prior year. That's roughly $10 more per month automatically deducted from your Social Security check. So if your COLA gave you about $50 more per month and Medicare took $10 of it, your actual net increase is closer to $40. Over a year, that reduces your effective COLA by more than $120, and that's assuming you're paying the standard premium. Now we need to talk about IRMA, the income-related monthly adjustment amount. If your income exceeds certain thresholds, you pay more than the standard Medicare Part B premium. For 2025, if your 2023 modified adjusted gross income exceeded $106,000 individually or $212,000 as a married couple filing jointly, your Medicare premium increases. In higher brackets, Part B premiums can exceed $600 per month. That's over $7,000 per year deducted from your Social Security benefits. And here's the catch. Medicare uses your income from 2 years ago to determine your current premium. So if you had a one-time spike in income in 2023, maybe from selling property, taking a large retirement distribution, or capital gains, you could be paying elevated premiums now, even if your income has since dropped. Most retirees assume that number is final. It's not. If your income has declined due to retirement, divorce, the death of a spouse, or other qualifying life events, you can file a life-changing event appeal. The form is SSA 44. Filing that form, along with documentation showing your reduced income, can lower your premium back toward the standard rate, For some retirees, that means saving $200 to $300 per month. That's $2,400 to $3,600 per year. Real money, and many people never file simply because they didn't know they could. Now let's move to the second major change. For decades, two provisions reduced benefits for public sector workers: the Windfall Elimination Provision, WEP, and the Government Pension Offset, GPO. If you worked in a job that did not pay into Social Security, such as certain teaching, police, firefighting, or municipal positions, these provisions reduced your Social Security benefits. Even if you also worked private sector jobs that did pay into the system, the WEP adjusted the benefit formula, often cutting monthly payments by hundreds of dollars. The GPO could eliminate spousal or survivor benefits entirely if you received a government pension. For millions of retirees, these rules significantly reduced benefits they had legitimately earned. Now, under the Social Security Fairness Act, those provisions have been eliminated. For approximately 3.2 million Americans, that means recalculations and retroactive adjustments. May is when many of those adjustments begin appearing in checks. Some retirees may see monthly increases of $200, $300, or more. Others may receive lump sum back payments for prior underpayments. If you worked in public service and had your benefit reduced under WEP or GPO, you should contact Social Security to verify that your recalculation has been processed. Don't assume it will happen automatically. Now let's talk about the earnings limit. If you are collecting Social Security and have not yet reached full retirement age, your benefits can be reduced if you exceed the annual earnings limit. For 2025, if you are below full retirement age for the entire year, you can earn up to $22,320 before reductions apply. Above that, Social Security withholds $1 for every $2 you earn over the limit. If you reach full retirement age during 2025, the earnings limit is higher, $59,520, and the withholding rate is $1 for every $3 above that limit for months before reaching full retirement age. Once you reach full retirement age, the earnings limit disappears entirely. Here's the important part: withheld benefits are not permanently lost. Once you reach full retirement age, Social Security recalculates your benefit and credits you for months where payments were withheld. But in the short term, your monthly cash flow can shrink significantly. If you are working while collecting benefits, you need to calculate where you stand relative to those limits. Finally, we need to address taxation. Up to 85% of your Social Security benefits can be subject to federal income tax depending on your combined income. Combined income includes adjusted gross income, non-taxable interest. Half of your Social Security benefits, if that number exceeds $25,000 for individuals or $32,000 for married couples filing jointly, up to 50% of your benefits may be taxable. Above $34,000 individually or $44,000 jointly, up to 85% may be taxable. Those thresholds were set decades ago and never indexed for inflation. That means more retirees are pulled into taxable status every year simply because benefits increase. Now here's what you should do this week. First, log into your My Social Security account at ssa.gov. Review your benefit statement and earnings history. Ensure every year of earnings is correctly recorded. Your benefit is based on your highest 35 earning years. If any year is missing or incorrect, your benefit may be lower than it should be. Second, if you were affected by WEP or GPO, contact Social Security to confirm recalculation and any retroactive payment eligibility. Third, if you're paying more than the standard Medicare premium and your income has declined since 2023, file Form SSA 44 to request a premium adjustment. Fourth, if you are working and collecting benefits, verify that you are within earnings limits to avoid unexpected withholding. Fifth, review your tax exposure. Work with a tax professional to estimate whether Social Security benefits will be taxable this year. You worked for decades. You paid into the system through every paycheck. This is your money. The system doesn't automatically optimize for you. It responds to people who understand the rules and act. Now you know what changed. Now you know what to check. Act accordingly.